If there's any time to pay attention, it's right now. What we are seeing today as of this video being published, the most important factor could be determined at this moment. In fact, you might be watching this video, the news is already out. So stay tuned, I'm gonna bring you everything you need to know leading up until this point, and then after I'll post another video giving you what you need to know surrounding that information. I'm going to give you the breakdown, number one, with the Fed's big day leading up into that. The second thing is the big swings, what's been happening so far with the NASDAQ. Maybe you own some stocks, maybe that relates to certain companies that you are indirectly involved with. So stay tuned on that. And the third is what's happening in emerging markets as well as Asia. I've got all of that and more. Let's begin. We'll begin right here. The Fed is likely to signal a March interest rate hike, that further policy tightening is coming. Yes, everybody is anticipating this. We will see if that's the case by the time it actually comes. We could be in the state of, perpetual new lows all throughout February, and then March time comes around. Hey, maybe they'll have a change of heart, but not necessarily the case, at least in a historical sense. We will see though. I don't think they're going to be spooked by this. They need to tighten financial conditions so that they have a better handle on inflation. Maybe this is just some steam coming off the top. If you look at what's happening to the markets, yes, they've been selling off quite a bit. They are in fact overreacting to the information because nothing has really changed over the last little while. I mean, think about it for a second, right? There hasn't been anything. We knew this was coming. We knew inflation was getting hot. We knew all the details. And now suddenly the market is starting to react to it. So that's the way it usually is, in fact. But you look here, Jerome Powell, what is he going to do? What does he have to do? In the statement, the Fed said that in determining whether it would be appropriate to raise the target range at the next meeting, the FOMC will assess progress, both realized and expected, towards its objectives of maximum employment and 2% inflation. The key to this statement is the reference to the next meeting, not codifying such intentions, such inject policy uncertainty it could inject uncertainty into the March pricing. Now, this is important because of the policies that they put through. It's all hearsay and talk until that moment actually happens. And it is very unlikely that they will actually implement anything at this meeting. So stay tuned for that. Look, I don't want to get too much into it because we don't know what's going to happen until it does. But what you need to understand is when you look at these different models or just look directly at these statistics, we are potentially heading towards recession. And that goes for different PMIs. It goes for, in this case here, global recession model brought to us by the NDR. Every different company and different institution, they've all got their own ways to model it, and we never really know. But all we can take from this and from the others is that we have historically very, very high prices in stocks, and yet the economy has not performed as well. We've got a bunch of people that are out of the workforce. They haven't come back in. We've got, these many different indicators showing us a slowdown, right? At the same time, we are being told over and over and over again that not just the Federal Reserve going to be increasing interest rates, but guess what? A whole bunch of other central banks doing the same thing. Okay, so that's big because it's not just one. You can look at the technical analysis and see what's happening here with the stock market and the way they are reacting. All I'm showing you here is the RSI, the relative strength index of the NASDAQ. And at the bottom, it's the S&P 500. And essentially just showing us, going back from 2018 up until the present, this is a major sell-off that's taking place in terms of how oversold it is on a technical level. Why? Because the markets are concerned, think about it, haven't dealt with rising interest rates for years. And now suddenly we're going into that mode. What does the market remember? Well, the market remembers one very important thing, that the last time around, the markets performed extremely poorly throughout a hiking cycle. So that's so key to understand, all right? Now, let's take a look. Let's go a little deeper. I like to use these transitions to break it up a little bit as we move into the next part. Strategists predict trouble for US stocks after massive U-turn. Bespoke says NASDAQ historically drops after a big reversal. Evercore says Fed put. KBR cautious on clown stocks. So what are they talking about here? We could have a resurgence. That could happen. However, markets could fall. You look at this individual company, what this person says, then you look at JP Morgan, you look at Goldman Sachs, and they may give you completely conflicting information. So what do you take? What can you do? Well, I see the general advice to simply buy every day, every week, every month, on whatever schedule makes sense to you. Dollar cost average, no matter what. Now, I think we can do better than that. I think it's pretty obvious when you have extreme weakness to simply take a step back, to not necessarily act. It doesn't mean you got to sell everything. Do what you want. But I think there are certain times when it's pretty obvious that it's probably better not to put your money into the fire. But you take their advice and do what you will. That's all I'm going to say. This is the US Financial Conditions Index actually turning up somewhat. I've been showing you this one and others. While it was getting easier and easier and easier, we have seen somewhat of a less easy, it's still historically very easy. The chart goes back to 2012, and the conditions have never been easier still, but we see that turn. Now, what's happening here? Could the market start to get real with increasing interest rates? Could that happen? My goodness, the market doesn't like that. And one of those that don't like it, let me tell you, are the tech stocks. NASDAQ, new 52-week lows. Other than what happened March 2020, the last time we saw this was back during the financial crisis. And there's literally only a couple times. The chart goes back from 2000. We've only seen this a couple times. Why? Because if you look at not just the NASDAQ, but break it down even further, there are a lot of stocks today that are very weak. Even before this, the last, let's say, week and a half. It was unbelievable to see how much volume was traded on the QQQ. That's the NASDAQ ETF, of course. Just showing you, okay, let me pull the highlighter really quickly. Over the last few years, there has been more volume on these. Okay, we got it. Understood. However, we've never seen anything like what we just saw. You saw that surge in volume. The market, the Dow specifically, was down at over 1,000 points, and then it finishes up positive on the day. Very, very unusual, to say the least. There's a lot of interest. There's a lot of speculation. There's a lot of people saying this is the dip to buy, and the other people are saying this is when it's going to crash. I don't know. I don't know the answer, despite what the comments, sometimes I see the hilarious comments suggesting that I have a crystal ball or I pretend to have a crystal ball. I don't know what's going to happen. Certainly there are trends that are very, very obvious. I point those out. But anyway, rates up, profits down equals a bad combo for risk assets. So when you look at what's happening with the conditions today and you see, increasing interest rates, even if it's a small amount, it still dampens what we would have to see over a period. When you look at the financial conditions getting a little bit tighter, that's always going to be somewhat of a negative to risk assets. What are risk assets? Well, you can see stocks as risk assets, but you break it down a little bit further, and that could be those unprofitable tech stocks. Maybe you want to go over to the cryptocurrencies and see those for a moment. You can look at NFTs and all these other things that are technically very risky. And of course, you see what's happened recently. Okay, really quickly here, a lot of people were asking about this. I made the shirt by the dip. And this is kind of the fun one. This is the big one. Okay, there are different designs. I thought this was so cool because they allow you to print way off of the normal borders. So it's a huge one, but Dip the Avocado says, but you can get a normal t-shirt here. This is just a regular size. The other one's massive. Got all different designs, sweatshirts, and so on. So hope you appreciate that. Let's look at the next step. Let's look at what's happening. By the way, the links for that are down below. You can see under the section that says t-shirts and also in the sources as well. Look, let's talk about emerging markets right now, okay? Let's get into it. Emerging market monetary policy tightening cycle is well underway. Remember that. Okay, because the Federal Reserve might be the biggest, might be the most important in some sense of the word, but they're not the only one. Look at mass population. Look at the economies growing in emerging markets, how important they've become for their appetite of imports, but also what they're doing with exports. I mean, we can't deny that. When you look at what the central banks are doing, if they're all moving in one direction, we could see the world doing that. The only one that I'm seeing right now that basically globally is not going in that direction. Well, we have Europe and the ECB, but that's just gone. And Japan, they're finished. Some people get offended by that, but I mean no offense. We're talking about the central banks after all. But look at what's going on with excluding China, everybody else tightening. That's all I'm trying to show here. The forecast, we never really know. House of cards, many stock gauges in Asia are close to a correction or bear market territory. So you look at this, whether it's China and even here, New Zealand, Japan, and Australia, and so on, all down big. So we will see what happens in the coming days as the market digests this information, as the market reacts to it. What has happened? We will talk about that. Stay tuned to the channel. If you hit the thumbs up, you're actually more likely to see these videos in the future. You want to check in with these. You want to be able to get the information because I give you the raw data. I let you decide, okay? If you want to buy the QQQ, or if you want to buy the SQQQ, that's up to you. You've got to be the one to say, yeah, I know, I got the information, I see the trends, and now I'm making that decision. It's all on you. I hope you do appreciate that. If you support the channel, simply give that video a thumbs up. It's right down there. I appreciate that. The algorithms are going to let other people out there know that this is some good stuff. So thank you for that. If you haven't seen this video yet, you definitely want to check it out, all right? Just click it and I'll see you there.